Welcome everybody to this webinar on rethinking insolvency and crisis management in these difficult times of the COVID-19 crisis. We are delighted to be able to present this webinar because it's a joint cooperative effort between the International Development Law Organization and Queen Mary University of London, and especially its Centre for Commercial Law Studies. I'd like to begin by particularly thanking the International Development Law Organization for arranging and providing the Zoom platform for today's webinar, and two colleagues at IDLO, Lubomir Petrolyeskov and Lorenzo Piacentini, for their real assistance in this effort. And before we actually begin the substance of the webinar, it's my great pleasure to introduce to you Professor Ian Walden, the head of the Centre for Commercial Law Studies of Queen Mary University of London, to say a few words. Ian.
Thank you very much indeed, John. As John said, this is a joint webinar between IDLO and the Centre for Commercial Law Studies located at Queen Mary University of London. And it represents the first of a fruitful relationship that we have established with the IDLO through a memorandum of understanding. The IDLO and the Centre for Commercial Law Studies share a common interest in the role of law in economic development, and the MOU was designed to encourage a whole series of activities between the two institutions. But I just briefly wanted to let some of you know who and what is the Centre for Commercial Law Studies. We are in fact celebrating our 40th anniversary. We were established in 1980 by Professor Sir Roy Good to specialise in commercial law. We are unique in the world, we think, by being exclusively focused on masters and PhD students, so postgraduate legal education. We have students from over 95 different countries. We have over 1,000 students studying at the centre in any year. And we cover the whole range of commercial law studies and bring together the keenest academic thinking with the blunt practitioner viewpoint, and ensure that the practice of law and the academic focus on law come together in a fruitful exchange. So that's who we are, and as I said, we share very much and are very pleased to have entered into this MOU with the IDLO, and it just remains for me to thank the organisers, particularly Mary, and to thank John and the speakers for giving of their time today, and I hope you all have a very fruitful webinar. Thank you very much indeed.
Ian, thank you. Just before we begin, also the substance, could I mention some administrative details? You'll all be aware of the way in which Zoom meetings are held these days. The host function is being held by our colleagues at the International Development Law Organization, and they will be sharing the screen to the extent to which they can with each of the speakers, but the slides would be available for us all to see. As the moderator, I will intervene from time to time, but only as needed. As you know, the webinar has been structured as two panels. The first dealing with insolvency of banking institutions, and the second dealing with insolvency of non-financial institutions. And after the three speakers in the first panel, the banking institution panel, we will have a period for questions. I should invite all of you to offer any comments or questions via the chat function, which, as you will know, is sitting at the bottom of your screens as you look at the slides, as you look at the Zoom screens. And there'll be a period of questions and answers after the first panel, which I mentioned, and then we'll have the two additional speakers speaking on insolvency in non-financial institutions, followed also by a short question and answer session, and then we'll be wrapping up. I'm pleased to say this panel has agreed that not only their slides can be shared with all of you and available after the presentation, but also that this webinar is being recorded. And so if any of your colleagues who are unable to join us today would like to listen and learn in the future, that will be possible. So I think that gets through the administrative material. And what I'd like to do is now very much introduce the first of our speakers on the banking topic, Dr. Ender Emre, who is a counsel at the International Monetary Fund. He's been there about 4 years. He was formerly with the Banking Regulatory and Supervision Agency in Ankara, Turkey. He's had a wealth of experience in this area, and it's therefore a great pleasure for me to introduce him. Each of our speakers will have about 15 minutes for their presentation. There's so much to cover here. I'm sure you're all aware that they will be just scratching the surface, but I'm sure we will all learn a great deal. So Ender, please, the floor is yours.
Thank you very much, John. I'm very glad to be part of this event organized by IDLO and Queen University. Just maybe a quick correction from the beginning. I mean, I don't hold a PhD yet. It's been a long-standing PhD exercise for me for almost like 10, 11 years, but still it is there. So I think the first thing that I would like to do in my presentation is, before entering into a discussion on COVID-19 crisis, to give a brief overview of financial safety net and crisis management arrangements to better understand actually how the response during the COVID crisis fit into this broader framework. Financial safety nets include a set of mechanisms that promotes the solvency and liquidity of financial system and preserve depositor confidence. If we can move into the next slide, please. As you see on the left side, this financial safety net is comprised of 4 components: emergency liquidity assistance, effective deposit insurance systems, supervisory early intervention, and effective resolution frameworks. Each has a unique function and they interact with each other in a coordinated manner. Supervisory early intervention is mainly there to reduce the likelihood of a failure, not to prevent failure per se, but to reduce the likelihood. Resolution frameworks reduce the impact of a failure when it happens. So in contrast to early intervention measures, it entails the placement of a non-viable bank under the full public control to reorganize its business and or liquidate it. Deposit insurance schemes, as we well know, that they enhance depositor confidence and reduces the likelihood of a depositor run. and emergency liquidity assistance try to address idiosyncratic liquidity shocks in the market. But mainly financial safety nets are designed in mind to apply to idiosyncratic situations. When we have a system-wide situation, actually the response could be different. In such a case, crisis management involves a set of tools and policies used to contain and stabilize a system-wide crisis, followed by banking sector restructuring to address the underlying weaknesses and later to manage the assets. Here, please keep in mind that financial safety net components are still relevant, but they are being implemented in coordination with other measures, other broader measures that are put in place by the government, including system-wide liquidity and solvency support or possible administrative measures, including deposit withdrawal restrictions or in some extreme cases, capital controls. Next slide, please. Returning back to COVID-19 crisis, I think we may briefly look into the initial response because it's been described as a crisis like no other, and then basically the response has been also like no other. These response included government measures, including debt moratoria or large-scale fiscal support, including credit guarantees. Central banks addressed liquidity strains in key funding markets. Supervisory authorities tried to exercise their existing powers with flexible implementation to still uphold the minimum prudential standards, providing necessary guidance to institutions while also encouraging debt restructuring and promoting the relief measures targeting entities and selected sectors. And while banks entered into the COVID crisis stronger compared to how they entered into the global financial crisis, their financial standing may still be affected from the pandemic crisis. I think that Marco will look into this issue in more detail. But some banks may face liquidity pressures due to concerns triggered by the pandemic, particularly if those banks had previous weaknesses prior to the pandemic crisis. Or the economic contraction may also affect bank solvency ultimately, and the question may become how to ensure that losses are recognized and absorbed in an orderly manner while also providing necessary support to economic functions. This issue can be quite relevant to jurisdictions where banking system already had weaknesses prior to the pandemic, or where jurisdictions lack the fiscal space or access to funding to provide these fiscal measures to support the real economy and the banking sector, or where banking sectors are partially or fully dollarized and the authorities lack sufficient foreign currency to fund deposit withdrawals. So ultimately, we may have weak banks or failing banks during the pandemic, and there is a question how to deal with them. And as a lawyer, the main issue for us is how legal frameworks can help the authorities to adjust their policies. From a purely legal perspective, there is nothing that prevents the implementation of early intervention and resolution measures during the pandemic. So that's it. But we may need to be mindful of certain issues that may create challenges for their implementation as during normal times. And we can briefly look into actually what are the distinctive features of the COVID-19 crisis that may present certain challenges for the supervisory authorities and resolution authorities. First of all, I think we may need to note that the crisis is originated in the wider economy, not in the financial sector. The early intervention and resolution frameworks basically presume that the measures are designed with the presumption that the problems in the financial sector may be transmitted into real economy and disrupt the functioning of the real economy. But here we have a situation, the real economy is already disrupted by an exogenous shock. And then the other issue could be moral hazard issues, because normally when we have financial sector crisis, moral hazard is one of the biggest concerns that we have. But here in a pandemic situations where banks' financial standing is being affected from a totally exogenous shock, then the question is to what extent moral hazard issues may be relevant. We are not excluding this fully, but on the outset, I think that it may be a question to what extent this is relevant. There may be time and operational constraints in a fast evolving pandemic outbreak. the authorities may have a limited time or institutional or administrative capacity to design and implement solutions tailored to several individual banks. There are significant uncertainties affecting valuations and viability assessments amidst the uncertainties during the pandemic era. And there may be also concerns about the potential impact on starting interventions to multiple institutions, and this may somehow affect the confidence of the banking system in overall. And there may also be questions on the availability of private market-based solutions. Eventually, early intervention and resolution frameworks should try to find market-based solutions, but during the pandemic, actually, there may be a question about the availability of these options. So in view of the above concerns, can we move into the next slide, please? In view of the above concerns, it could be envisaged that the authorities could implement a policy response that is different than normal times on a temporary, targeted, and exceptional basis. The main function of the legal framework is basically to habilitate such temporary responses when needed, when policy justifications are there. And these measures should be targeted. When we mean with targeted, we are trying to distinguish between cases that are related to COVID-19 or situations or the financial deterioration that are not related to COVID-19 crisis. It could be, for example, shareholder transparency issues, corporate governance issues, or excessive risk concentration even before the COVID. An example, as far as I remember, for example, Ukraine recently decided to suspend its corrective action mechanisms for institutions that are being affected by the pandemic crisis, and basically this suspension does not apply to institutions that have been whose financial situation whose financial deterioration is not related to COVID. And the question is how the legal frameworks basically provides this ability, this accommodative, how the legal frameworks can be accommodative of this policy changes. First of all, legal frameworks can provide flexibility in initiating intervention, or let's put it in a different way, in not initiating interventions. Because during the pandemic, the authorities may wish to consider the application of formal intervention regimes, where this formal intervention regime includes specific actions that are linked to specific triggers and triggered on an automatic basis. During normal times, such mandatory triggers are useful in terms of limiting the risk of forbearance, to increase certainty, and to also minimize the risk of legal challenges. But as we may see during the pandemic period, actually there may be difficulties in triggering automatic actions, and then the authorities should have the flexibility, ideally, to find a way actually to implement them in a flexible manner. But the question is how, again. If you have a legal provision in the law that says that you should initiate resolution when the bank's regulatory capital falls below the 50% of the required level, how the supervisory authority can basically navigate these difficult times under such constraints. One option could be even these automatic triggers are expressed in quantitative terms, these triggers still involve a supervisory judgment. For instance, the assessment of capital level and adequacy of capital levels will still involve a judgment about the quality of asset portfolio and the future prospects of the institution. In some formal intervention regimes, as we see like in the EU, the requirement under certain specific conditions, if certain specific conditions are met, the requirement is not to exactly take an action, but the requirement is basically to consider whether there is a need for an action, which may be a ground, which may be a middle ground to facilitate the response, because in that case, the risk of forbearance may be limited, but on the other hand, the authority can exercise its powers on a case-by-case basis. And in some cases, these formal mechanisms may themselves also involve some escape clauses under narrowly defined conditions, and this could also be a way for the authorities to basically flexibly implement even when they have such mandatory, such automatic triggers. And in relation to flexibility, I think that the other point we need to mention is the flexibility also in selecting and implementing tools, not only in triggers. As I think that Pamela will mention, for example, minimum bail requirements may be an impediment in the implementation of resolution measures. The other flexibility needed is in adjusting the duration of these measures, because in some cases, banks may be given a specific period by law to fix their problems, and the question may become relevant during the COVID crisis, whether these time constraints imposed by the law will facilitate the authorities' responses or not. And potentially, we would recommend normally a legal framework to provide this flexibility in adjusting the duration of the response. Next slide, please. I think that the slide number 6, yes. Given the above considerations, actually, the considerations that I previously mentioned, they apply to both early intervention and resolution measures. So these are general considerations. And if we speak to early, if we return back to only early intervention issues, I think that we need to say that the challenges presented by COVID do not mean that early intervention frameworks lose their significance. Just the opposite, actually, the legal framework for early intervention may become even more relevant to minimizing risks during the pandemic. There are a couple of measures that could be more relevant legally, and there may be some others from a policy perspective. For example, the authorities' ability to implement a gradual recapitalization could be one of the most important measures that can be provided by the legal framework and applicable during the pandemic. This would allow the supervisors to instruct banks to submit capital restoration plans to be achieved in a gradual but timely manner, and taking into account the potential duration of the shock and the likelihood of some COVID-related losses becoming permanent. Imposing stricter requirements, for instance, further limiting related party transactions, which may be a concern potentially while the bank is under some sort of distress. One relevant measure is, it's been highly debated recently. Basically, it's restricting capital distributions. When we speak about capital distributions, we are referring to the distribution of dividends, share buybacks, and discretionary bonuses. Why these are important? Because these are somehow to preserve the bank's capital base and to ensure that actually the available resources are being used to sustain the economy. But legally, we may have some problems there, because in many jurisdictions, it is not possible to implement such capital distribution restrictions on a forward-looking basis. In many jurisdictions, distribution of dividends can be prohibited or restricted in case such distribution would result in the bank falling below minimum capital requirements. Share buyback, in the case of share buybacks, the legal frameworks typically provide some limits or thresholds, and only if the bank exceeds these thresholds, there may be a requirement to get a supervisory approval. So the question in that case is, during the pandemic, while the risks are large, but still the supervisory authorities are unable to quantify them, is it possible, just out of prudence, to limit such capital restrictions? As we see, basically, it's a matter of to what extent the legal framework is allowing the jurisdictions to do so. And in the absence of such hard law powers, in many jurisdictions that we see, the supervisory authorities are seeking to use their moral suasion powers actually to achieve the same outcome. The other measures that may be relevant, we can say ensuring strong corporate governance during these distressed times. But one particular point, actually, it is also connected to resolution issues. Even early intervention measures, they involve still the bank remaining under private control. The supervisory authorities, in some jurisdictions, supervisory authorities are able to appoint a temporary manager to take the control of the bank. But still, the shareholder rights are not fully overridden, and the key corporate decisions are being taken by the shareholders, like restructuring, mergers, and recapitalization. As a result, even when a manager is appointed, the bank is still under temporary under early intervention. And this measure has been used in the past during in idiosyncratic failures, basically to prepare the bank for resolution, or to prevent any asset stripping or excessive risk taking, or facilitate any other measures. So, John, I cannot hear you. John, I cannot hear you.
I was going to suggest we may soon have to wrap up. Apologies.
Yeah, okay. So in that case, my point, the point that I'm trying to make is there may be a situation where the bank may be in need, maybe there is a need for resolution, but operational constraints or other considerations may somehow justify a policy response to wait and to see actually the quantum and the magnitude of the actual losses and to decide resolution maybe at a later stage. But this is a policy issue. From our side as a lawyer, our point is legal framework should be able to should allow the supervisory authority to take the bank's management, because in such cases, this could be a way to prevent in the interim any gamble for resurrection, or to prevent any fraud or any asset stripping issues. Next slide, please. And in respect of resolution, we need to be also cautious from the beginning, because post-global financial crisis resolution frameworks are largely untested even before the pandemic, and they are largely untested in systemic cases. And as we spoke, currently COVID-19 is an economic crisis, and as a result, containment measures are specifically targeting entities and households, but not direct support to the banking system per se. And legal frameworks can facilitate these targeted, temporary, and exceptional approaches. For instance, when policy reasons justify not initiating resolution during the onset of the pandemic. And as a result, again, we are returning back to, again, the question of whether we have some discretion in initiating resolution or not. Subject to operational constraints, legal frameworks for bank resolution can still be relevant. We need to be mindful that we are not saying that resolution is irrelevant. Resolution can still be relevant. It can be relevant even during the pandemic if we have an idiosyncratic case where we are able to assess the non-viability of the institution without any doubt, and we don't have any concerns about the potential spillover effects. The other case where it may be relevant is where solvency and liquidity problems reach to systemic proportions. Then resolution frameworks may, as we discussed in our first slide, may be used as part of the broader strategy to deal with the banking sector crisis. But this will take place only after there are containment measures that stabilize the situation in the financial system, and after we have able to identify losses and the bank's viability with some sort of clarity. In any case, when resolution is being implemented or is relevant during the pandemic, it's important that we maintain the safeguards provided in the legal framework for the use of public funds, because we still need to preserve minimize the use of public funds. And one potential area that we can foresee now is liquidation frameworks could gain some sort of prominence for the future, because it may be the case that smaller banks may be more affected from the pandemic crisis, and their resolution, going concern resolution, may not necessarily be warranted even in the future. So the question may be to what extent liquidation frameworks are capable of handling small bank failures. And I think that this can go to the discussion that Mario will have in relation to administrative liquidation frameworks and judicial liquidation frameworks. And last slide, please. And we need to be also referring to some institutional issues. Regardless of what policy adjustments are necessary, as usual, the autonomy of the supervisory and resolution agencies, their good governance, and strong interagency coordination are still key. When jurisdictions implement temporary and targeted exceptional early intervention and resolution policies, this should be still transparent. So there must be a clarity from the onset about the authorities' expectations, and this should be preferably mentioned in the legal instruments. And there must be the accountability framework should ensure that there is clear allocation of responsibilities and there is sufficient degree of reporting subject to confidentiality requirements. This means that potentially we may have more ex post reporting after the COVID. And there must be an exit strategy. And this exit strategy should determine and disclose the conditions to lift the forbearance measures and bring the prudential regulatory requirements to current standards. So that means when the jurisdictions implement some temporary targeted and exceptional measures, they should think from the beginning how they are going to exit from this strategy. And this should also be reflected in the legal instruments that implements this temporary and targeted framework. And these are my points that I wanted to make. Sorry for the delay, and hopefully we can have some more discussions during the Q&A session.
Well, Ender, thank you very much for this. It merely illustrates the complexity that this COVID crisis and the consequences of it will descend, or has already descended on us, but will continue with us for some time. And I was particularly impressed with the fact that you stressed going forward the need for flexibility and indeed the implementation of frameworks like liquidation frameworks, which may not have been as popular in the past, but which may be absolutely necessary going forward. I'd now like to turn, please, to our second speaker, indeed, Dr. Marco Bodolini, my colleague at the Center for Commercial Law Studies. He is an associate lecturer in banking and financial law at the center. He also teaches company law at the University of Bologna. Incidentally, all of our speakers, you can see their biodata on the program. So I do not intend to spend a lot of time describing their backgrounds. Please, though, refer to those as you can. And Marco, I'd be delighted if you would take us then through especially your views on the importance of effective bank crisis management regimes in our tough times.
Thank you, John. Thank you very much. Can you both hear me and see me?
Yeah. Yes.
Can you also see my slides on the screen?
Yes, I can. Yes, thank you very much.
Everything works out. Nice. Great. So yeah, let me just join both you and Professor Waldron in congratulating Queen Mary and IDLO for being able to put together this partnership. Today's event is the first event, but hopefully many more will follow up. As you can see from the title of my speech, I've been asked to talk about the impact of the COVID-19 crisis on the banking industry and the importance of effective bank crisis management regimes, which of course is a very timely topic, I think, given that sooner or later many banks will probably experience some issues. So just a couple of words about the way in which I intend to structure this presentation. I will divide this presentation into two parts. The first one mostly focused on the nature of the current crisis and the way in which I expect that this crisis will impact the banking system. And then the second part mostly focus on some ideas, or let's say thoughts, about how the banking sector could react, looking at both countries within the European Union and countries outside the European Union. So let's start with a few words about the current crisis. As Ender was mentioning before, this is a crisis structurally different from the global financial crisis of 2007 and 2009, whilst that crisis was a financial crisis arising out of the financial system and then impacting the real economy. This crisis is economic in nature and mostly is the result of the lockdown measures, the measures on social distancing, which many governments around the world have put in place with the final goal to try to slow down the propagation of the virus. Of course, in many countries, these measures have been effective for that purpose, but at the same time, they have also negatively affected the real economy on both the demand side and the supply side. So this is an economic crisis, as I said, but the main concern is that at some point the impact will also affect the banking industry. How do I see this impact taking place? I think we have already seen many enterprises struggling due to the fact that most of them have been obliged to stop their activities or to reduce significantly their activities. Of course, there has been a significant drop in the demand for both goods and services. Many households, many members of households have already lost their jobs, and at some point they will probably be unable to pay back their mortgages and credit lines to banks. And of course, these will kind of create issues in terms of transmitting these insolvency issues to the banking sector. Of course, all these, if replicated on a large scale, can be also potentially able to generate another global financial crisis. Which are the difficulties that banks are experiencing now and probably will keep on experiencing going forward? One of the main effects coming out from the current situation is the deterioration of the risk profile of many borrowers, which means from the bank perspective that banks are unable to lend money out. And this in turn can also further exacerbate the current economic crisis, potentially also prolonging its duration. But from the bank perspective, what can be even worse, if you like, is the fact that banks will end up with plenty of non-performing loans in their balance sheets. And this, I think, adds on to structural issues which have been affected the commercial banking business model, mostly in Europe. And here I'm referring to the low profitability which has characterized commercial banking in Europe, which again is connected to a number of reasons which we don't have the time to further discuss. In all this kind of very dark scenario, I think that the only good news is the fact that, as Ender was mentioning, banks are much more and better capitalized than they used to be during the global financial crisis. And this is the result of a number of regulatory and legislative initiatives which have been taken over time in the aftermath of the global financial crisis, with the precise goal to make banks more resilient and stronger from the capital perspective. So the main question here is whether this higher amount of capital that banks currently hold will be sufficient to allow them to effectively absorb the losses that they will experience as a consequence of the increase in the stock of non-performing loans. It's still probably too early to answer this question, even though among commentators, policymakers, and scholars, there are already two opposite schools of thought. Some of them are arguing that the amount of capital should be enough for banks to absorb losses, and therefore they should also be left free to distribute dividends and buy back their own their own shares if they want to. On the other side, we have other people arguing that this is not the case. It's still too early to forecast whether this higher level of capital will be enough. And in the meantime, banks should be prohibited from distributing dividends. And this is the approach which has been taken by both the European Central Bank within the Euro area and also by the Bank of England, and recently also by the Federal Reserve in the US. The point is that if the banking system will manage to absorb these future losses, then of course it will be able to survive, and it will avoid its collapse. But if this will not be the case, if a significant amount of losses will be recorded, then at some point banks will have to recapitalize. What's the problem here? The problem here is that we might find difficulties in finding private investors willing and able to subscribe to large banks' increases of capital, because they have been in turn hit themselves by the current crisis. And that's why we need to put in place effective bank crisis management regimes apt to deal with peculiar institutions like banks, which also rely on the possibility for public intervention. This is also connected with another very important argument, which is the following: the fact that the banking system will be key to allow for an economic rebound when the pandemic will be over. So that's why we need to have in place a healthy and well-functioning banking system. Let me now spend a few words on the importance of bank crisis management regimes, what I mean by bank crisis management regimes, and also a sort of general and brief overview on the tools and the procedures that I have in mind in order for a bank crisis management regime to be effective and to be fit for the purpose. In this presentation, I use the expression bank crisis management regime in a very broad sense to refer to potentially every legal or regulatory tool or procedure that authorities, depending on the jurisdiction in question, are empowered to adopt in order to effectively handle troubled banks at every stage of their life, and also in the context of systemic crisis. The main takeaway from this perspective is that, in my view, effective regimes should provide the authorities with the full range of tools. And then, in turn, they should also give the authorities a significant amount of discretion, allowing them to pick the right tool within the right procedure after choosing on a case-by-case basis. What's the consequence of such an approach? That you also need to put in place a mechanism to make the authorities accountable to a democratic body, such as, for example, the parliament. But this shouldn't be an obstacle as such. A few more words on the bank crisis management regime that I have in mind. Let's start from a simple assumption, which is the following one. There is consensus among commentators, policymakers, scholars in arguing that judicial insolvency proceedings, which are purely aimed at liquidating the entity, are not apt for banks. Why do I say so? Why do they say so? Because these regimes are mostly focused on liquidating the assets and use the proceeds arising from the sale to repay typically only some of the creditors. In this way, you will never manage to make the critical functions of the failing bank to continue, which is an issue because the very fact that the critical functions stop is in itself able to produce a further level of issues. What I mean by critical functions that should continue are typically depositors' access to their deposits, payment services, and lending. These three functions should continue because otherwise their discontinuation might be able to further endanger a current problem. This assumption, then the question is, how can we find a way in the context of an insolvency proceeding applying to a failing bank to ensure that these critical functions can continue? And the answer is taken from the resolution regime, in the sense that we can allow the authorities which actually handle bank's crisis in the context of an insolvency proceeding to also apply resolution-like tools, such as, for example, a sale of business-like tool, a breach bank-like tool, and an asset separation-like tool. Similarly to what happens in the context of a resolution procedure. From this perspective, I think that there are two main jurisdictions at the international level which are particularly interesting because both give to their authorities involved, resolution-like tools. The US on one side.
Apologies to interrupt. But to enable other speakers, I'll have to ask if you can just summarize very briefly US and Italy. Thank you.
Yeah. So US is interesting, even though for non-European Union countries which have in place agreements with the European Union to align their regimes to the EU, the US system might not be particularly appropriate because of a number of structural differences. Still, the fact that in the US they have a centralized authority, the Federal Deposit Insurance Corporation, benefiting from the powers which are typically given to a deposit insurer and to a resolution authority, is considered one of the main reasons for the success of that system. In Italy, what we have is the possibility to submit failing banks which do not meet the public interest test for resolution to be submitted to an administrative procedure called compulsory administrative liquidation, in which the authorities in charge is given the power to transfer assets and liabilities to another bank, which is exactly the point that I was trying to make before when I was speaking about the need to find a way for the critical functions to continue. Through this transfer, critical functions can continue. Then the question, of course, is, yes, but who is gonna pay for the mismatch between liabilities and assets? Because of course, if the failing bank is failing, that's because the amount of liabilities exceeds the amount of assets. The answer could be through a more significant involvement of deposit guarantee schemes. I don't have the time to go through the European Union legislation, in which we have a number of limitations, both in the state aid rules and due to the fact that deposit guarantee schemes can benefit from the application of the depositor preference rule in the context of insolvency, but still both these rules do not apply to non-EU countries. So there is potentially room for maneuver. And I will stop here, and then if there are further questions on these, I'm more than happy to expand.
Oh, Marco, thank you very much. And I'd like to just observe that as you will already know from our first two speakers, this is such a rich topic, and we have such experts on the panels today that so many issues could be discussed and that will not be discussed. But already ideas are emerging, as you well know, for solutions to some of the difficulties that we all believe will be undoubtedly facing us. Now I'd like to turn to our third speaker, Dr. Pamela Lintner. Dr. Lintner is a senior financial sector specialist at the World Bank. She is currently, though, at the Financial Sector Advisory Center, which is a joint collaboration between the Ministry of Finance of Austria and the World Bank itself. And she specializes in advising on crisis management in Eastern Europe and Central Asia, and particularly in bank recovery and resolution. So she's very well situated to address us. And Pamela, I'm delighted to give you the floor.
Many thanks, John. And many thanks to IDLO and Queen Mary University for the invitation. I will quickly run through the first slides, as a lot has already been said by Marco and Ender. So what we do at FinSAC is we provide technical advice to our client countries in Central Eastern Europe on reviewing the regulatory framework in bank resolution, but we also provide hands-on support in drafting recovery, in assessing recovery plans and drafting resolution plans. We are now starting to providing advice and how to see how we can help our client countries to manage the COVID crisis and the effects of the crisis on the banking sector. On this very first slide, I have taken and copied a really good graph from the BIS paper, which very nicely shows that even though the crisis originated in the real economy, the effects on the bank stock prices were exactly the same as under Lehman, which I found very surprising to see. It has, because of the government stabilization measures, Marco and Ender have already mentioned, the situation could be controlled very fast. And now I would say we are in a stabilization phase. Banks also are better prepared. As Marco said before, they have higher liquidity, higher capital, but what not necessarily is the case, not all banks have higher leverage. So if the losses are high enough, they are not necessarily that much better prepared in real terms, taking into account the risk-weighted assets and the the risk weights ratio. So on the leverage side, there is not so much progress, which is very important actually, of course, when it comes to bail-in and the loss coverage. On this slide, just a quick summary, it has already been said, an overview on the government's intervention measures. The first two measures, borrower relief measures, credit guarantees, indirectly affect the banks. They play a pivotal role in implementing it. Then the other three measures are directly addressed to the banks. There are the capital relief measures, other capital retention measures, and using as much regulatory flexibility or forbearance, if you want to call it, in requesting additional capital, in taking all the intervention measures. I think we are currently in this stabilization phase. COVID did so far not really touch upon banks' capital apart from the distribution measures and the prohibitions in that area. But we have not really seen a rise in NPL so far because of the government interventions. So the critical time will come when these interventions are lifted. And for that, we should be prepared. And a key area, of course, to prepare for that, and what we of course advise authorities to have in place is a resolution framework next to a liquidation framework. The international post-crisis resolution framework is actually the child of the last systemic crisis, the global financial crisis. The key attributes for bank resolution are the new international standard. In the European Union, this has been transposed with the BRRD, in the US with Dodd-Frank, even though the two systems are very different. We will have a closer look in a minute. And many of our FinSAC client countries who are accession countries or want to have agreements like accession agreements with the EU, they are aligned with the European framework without necessarily taking it over one-to-one. That's actually our key, most of our work we spend on advising countries what not to take over from the European framework. In principle, the bank resolution framework is meant to deal with situations of bank idiosyncratic crisis as well as for a systemic crisis. So the two systems we at the international level, which I compared on this slide, and Marco has touched upon it before, is the US system and the European system for bank resolution. You can see here that in the US system, they already had the FDIC empowered with resolution powers. They already, next to a payout, what we call like under liquidation, they had a P&A bridge bank powers. Now, after the global financial crisis, they adopted the Orderly Liquidation Authority, empowered FDIC with additional powers for financial holdings. And under this resolution scheme, they would apply bail-in at the holding level, the bridge bank, and keep all the operating entities going concern, as Marco said before, to continue the critical economic functions. The system in Europe is that we have, in principle, one resolution system for all banks, even for the small ones. There is no quantitative threshold for which banks' resolution tools can be applied in Europe. In Europe, there is a public interest test, which is rather flexible, with pros and cons of having such flexibility. On the one hand, in terms of obeying to the rule of law, you would prefer to have as less discretionary exercise of powers, as much predictability as possible. On the other hand, there are very good reasons for providing this flexibility. Especially when you think about a systemic crisis, you might have smaller banks which are not in the public interest in case of an idiosyncratic failure, but in a systemic crisis where you have a certain region more strongly affected by COVID and also the economy more strongly affected. Several smaller players would be of systemic importance. They could create a contagion also in other regions or the whole country or cross-border. So this flexibility, I think, is definitely needed even more in a systemic crisis. In the past, we have seen that the public interest test was applied in very different ways. We have one Italian case like 3-4 years ago, where even small banks were put into resolution. We had bigger banks that were not put into resolution, but the national insolvency law was applied. In the Italian case, as Marco said, the national insolvency law does allow for resolution-like powers, which I think is an area for improvement in many other countries, to also stipulate for certain type of resolution powers for the smaller ones, not necessarily for the open bank bail-in. So that's the main difference between the bank liquidation and the bank resolution scheme. Under the resolution schemes, you continue the bank operating. Under liquidation, you would stop the bank one way or the other. I would like to focus now on the main differences of bank liquidation and bank resolution in terms of financing losses. In terms of financing losses under bank resolution, you can apply bail-in, which means you do not necessarily follow the strict creditor hierarchy as you would in a liquidation. Also under liquidation, the objective is to maximize the return for investors, whereas under bank resolution and bail-in, you take measures to continue critical functions and reduce, try to preserve systemic financial stability. So bail-in is the new kit in the resolution toolbox. It's a two-step process. You first write down capital, then if losses are higher, you would write down the debt. And if you have written down all the losses, then you need to recapitalize the open bank. And for that, you convert certain creditors into new shareholders. The legal safeguards for interfering in such property rights is the famous no creditor worse off than liquidation rule. So you really need to be prepared for bail-in. This is why I put this slide. You need to see bail-in in the context of resolution planning. You could theoretically apply bail-in without having a broader framework prepared and approve ad hoc law to allow for bail-in, but that would make it much more challenging and legally risky. We have seen in Banco Popular, even if you are prepared, you will face many litigations. And a key element of being prepared for bail-in is to make sure you have the creditor hierarchy right, which means under bail-in, you do have the power to differentiate among the same hierarchy rank. So even in a pari passu, you do not necessarily have to treat all creditors as in a liquidation. Pari passu, you can divert from that, which creates legal risks. And the safeguard is the no creditor worse off than under liquidation. To reduce such a risk, in the European Union, a new class of senior non-preferred creditors was introduced to ensure that you do not face this litigation or you reduce these litigation risks. Additional difficulties we do see in our client countries are problems in raising this loss-absorbing capacity via debt instruments. If you have an underdeveloped capital markets, you run the risk of having to bail in uninsured depositors, something which politically you wouldn't want in most cases. It did happen also in the US. Uninsured depositors under the traditional FDIC rules are often left behind, so it does happen. But to convert them into shareholders, you need to make sure they are fit and proper. You have additional contagion risks in less developed markets where very often you do have liabilities in the hands of a very small number of investors. You do have additional cross-border challenges when debt instruments are issued under third country law or under the law of the parent bank. So it's much more difficult. You need much more preparation in less developed markets. Even though banks are smaller and probably simpler, to manage the legal side, I think, is more difficult in less developed markets. A comparison on the use of public support, as both of the speakers before did stress, the whole idea of a bank resolution framework of the key attributes is to avoid a bailout, to avoid using taxpayers' money. Also in a systemic crisis. This is what the resolution system is made for, to deal with a systemic crisis. You do have a prohibition of using taxpayers' money under the US. There might still be options and a misuse, as the US Treasury OLA report says, to bail out certain creditors. In Europe, we have the famous obligation to bail in at least 8% of a bank's balance sheet before you are allowed to provide public support or use the resolution fund. This is really strict and regularly goes beyond junior creditors. So you do, in most cases, you do touch upon senior creditors are now into the new senior non-preferred class. Or in our client countries, very often you would touch upon uninsured depositors. This 8% prior obligation is not that explicit in my reading of the law, and it's really a personal statement now when it comes to the bridge bank financing. It's probably against the spirit of the whole framework, but there, in my view, there is no explicit prohibition. Also not for the use of resolution fund money. There, the 8% for bridge bank financing is not that strict or clear. Of course, you can use public money prior to resolution. There are also, as Marco said, limitations on that in the European framework. Here a slide for the ones among you who are more interested. What Marco said before, an overview how you could finance the asset liability gap under the European rules. If you're interested, I'm happy to discuss this in more detail later. Just let me conclude with 2 slides and 3 main comments. Taking of preventive measures will be very difficult in constrained financial market situations in a pandemic crisis. So you won't have people, investors, you also not banks to take over other banks. The issue with recovery and resolution planning is under the European rules and also in the US limited to applying bail-in. Resolution plans do not provide for a broader burden sharing concept. And especially in a pandemic crisis, you might need that. And also, as Marco said before, resolution frameworks do not plan for the resolution of smaller banks. In a systemic crisis, you might need to apply resolution tools to smaller banks for which you did not develop resolution plans. So authorities should really start to think about broader contingency planning outside resolution plans. Again, with bail-in in a system, it's a key firewall to public support, something we all want to avoid, using taxpayers' money. But in a systemic crisis, you might need to combine it with, to find a combination between bail-in and bail-out. What we have seen in some client countries, and that's really interesting, is many European countries now prepare to operationalize bail-in. We have bail-in playbooks prepared by the banks to get to know the liability side, something the supervisors usually don't look at in that granularity. It's really something for resolution authorities. There is testing of operationalization of bail-in, but what authorities very often do not test is cooperation between the resolution authority and the Ministry of Finance. Also under the European framework, you would need to combine bail-in with a bail-out. I think in a pandemic or in a system-wide crisis, that will be most likely the solution or the way to go forward and find a solution, be it via bridge bank, be it via open bank recapitalizations. But, and the law, we have checked many member countries' laws, they all provide for cooperation at a relatively high level with very nice wording. But then when it comes to a granular, when you really think about how do you then sit together and who decides what? Who decides if there is a systemic event? Not even that is always clear. Who would adopt the resolution decision? Is it the resolution authority combined with the ministry, each of them separately? Regularly, all those aspects are not regulated in the law. And if you're not prepared for that, you would need to come up with solutions within a few weeks and risk even, and have to deal with even higher litigation risks. So the key, that's really our key message, is to get prepared in implementing the regulatory framework and really sit together and draft decision-making processes, or do some small simulation exercises. The bigger, more philosophical questions I will leave for the discussion. What I don't have an answer to, but I would find very interesting to discuss, is if bail-in now is really a tool to end too big to fail in a systemic event. Also, is it the right tool when you think about the moral hazard? Ender mentioned it in his presentation. In principle, you want to punish shareholders, debtors for bad investments. You want to make sure there is a correct risk pricing. But does this also apply, this moral hazard, in an exogenous shock like a COVID? It's a more philosophical question than a legal one. And the other is, to a certain extent, a legal one, the repercussions of bail-in, of the expectation if authorities would really apply bail-in or not on the taking of early intervention measures. So do market participants expect to lose or to be converted under bail-in? On the one hand, you could argue if there is an expectation of bail-in, there is actually no need to take restrictions on capital distributions because they would face the loss anyway later. The other argument is you would like to make sure to reduce the loss as much as possible, not to have to go down the creditor hierarchy till uninsured depositors. With that, I would like to close.
Pamela,
Yeah.
thank you very much. A third very excellent presentation. I see that our time is marching on, but there have been no questions coming in through the chat mechanism. So I'd like to just ask, well, one question in particular, and then we can move on, I think, to the second panel, because I really want to give, of course, our two speakers in that panel more than adequate time for their presentations, which I know we're going to find very interesting. But within the banking sector, could I ask perhaps each of you very briefly to tell me at this time, where we are at this time in the COVID crisis, not where we might be in a year's time or where we might think we might be, but at this time, what's the single activity that should be undertaken especially in the emerging countries that many of your organizations really provide great assistance to? What would be a single element that you think those countries should focus on, even though I realize that from country to country, the circumstances may differ? Who would like to have a shot? Please, Enda, would you like to?
Yeah, John, I'm happy to do so, but maybe we have an issue. I mean, we need to, as I said, we need to distinguish between policy response and a legal perspective.
Correct, and therefore, I should have clarified. Maybe focus on the legal perspective.
Yeah, so I think I would think from a legal perspective. I think based on what I have tried to convey in my presentation, I think while the COVID crisis has not translated into a financial crisis yet.
Yes.
It could be a good opportunity for the authorities to consider actually to review their legal framework from a legal perspective, to review their legal framework, to understand actually what are the shortages, what are the gaps as compared to with good practices. Because if you look at the messages given by standard setting bodies like Basel Committee, you'll see they are always referring to one particular issue. They're generally referring to embedded flexibilities in good practices. So then the standard setting bodies advise presume that actually these flexibilities are already in place in jurisdictions' legal frameworks. Then, as we say in that case, we need to look into actually to what extent the legal framework in a particular jurisdiction is delivering these flexibilities. And I think the other points relevant are, as we discussed, and thanks to Pamela mentioned, to what extent this legal framework is addressing moral hazard concerns when it arises, and to what extent this framework is facilitating accountability and also cooperation, interagency cooperation, and if necessary, cross-border cooperation. So I think to cut it short, it can be an opportunity to review the legal frameworks in that regard.
Yeah, so thank you. Thank you
And
very
and,
much.
and just to conclude, I mean, like even just before the crisis, I think that we have seen in the Eastern Europe and the Central Asia recently, actually, many jurisdictions have undertaken these reforms, and we can potentially link this to somehow with the EU aspirations, and as part of the EU association agreements, some countries have committed to transpose the EU framework in line with their jurisdictional specificities. I can mention, like, recently Georgia has undertaken a very successful bank resolution reform. In Serbia, it has been done maybe just a little while ago, but Bosnia Herzegovina, they have recently, I mean, I think that over the last year or the year before, they have adopted the new resolution framework. We can also see some changes in the Central Asian region. Tajikistan, for example, they have put place they put in place a resolution framework that is seeking to comply with international good practices, and particularly bringing improvements compared to the previous regime. And we can see, as I said, the similar attempts also in other Central Asian countries.
Yeah, no, thank you very much, Endo. That is very helpful. Well, I guess if we go in the same order, Marco, did you want to add anything, please?
Yeah, John, thank you. I mean, I don't have really a clear-cut answer to your question. I'm inclined to agree with Ender in the sense that the fact that this crisis has not mutated yet in a financial crisis gives some time to legislators and regulators to take a look at the shortcomings of their internal legislation and the regulations, and possibly to rethink about them. I also agreed with what Pamela said in the sense that I think it would be just naive thinking that public intervention should be ruled out at this point. I think a combination, once again, of tools similar to bail-in, along with some sort of public financial support, needs to be put in place to be effective. Then the problem here is that, countries might find themselves in different positions, and not all of them will have the fiscal capacity to intervene in rescuing failing banks. But this is an issue which also affects countries within the European Union. And then from that perspective, maybe something that should be worked out could be some sort of mechanisms through fiscal incentives, for example, to try to channel private savings and private wealth towards equity investments in banks' capital. This is something that within the European Union is under consideration. There are, of course, a lot of ensuing issues, if you want, because then you will have issues in terms of corporate governance, effective corporate governance arrangements. But this could give some sort of room for maneuver also in those countries which do not have the fiscal capacity to directly intervene by recapitalizing failing banks, in a context in which probably bail-in is not the most appropriate tool, for the reasons that also Pamela was referring to. This is not a financial crisis. It does not really make sense to punish or to make shareholders, and even more so creditors and bondholders, to bear the losses.
Yes. Yeah, no, thank you very much, Marco. Very interesting further suggestions. Pamela, did you want to add anything? Please, because...
Not really much to add. I agree with both speakers, with Marco and Ender. Only for lawyers, something we usually do not do, really cooperate with the people who run calculations, do the calculations who will be affected by bail-in.
Ah, yes. Yeah.
Really do this testing.
The testing, yes. Well, I'm sort of astounded, and I'm sure that our audience is astounded too, because the the old adage is if you put 3 lawyers into the room and ask a question, you'll get 5 opinions. But in fact, there is remarkable consistency in what the 3 of you have said, but from different perspectives and with obvious knowledge. And I'm very grateful. Thank you very much. This has been an excellent discussion of the issues that are to be faced with insolvency of financial institutions. And so now we should turn to our second panel. There not being any other questions that I can see anyway. Please do feel free to ask questions. Well, hopefully we'll have some time at the end, but let's move along. Thank you to the 3 of you. It's been really enjoyable. And please stay on, of course, because we'll now look forward to hearing from Catherine Bridge-Zoller. Catherine is a senior counsel in the legal transition team of EBRD, European Bank for Reconstruction and Development, with special responsibility in restructuring and insolvency. For those of you who don't know, the legal transition team is effectively a team of specialists at EBRD who are looking to develop law reform solutions for the countries that EBRD serves, and basically promotion of capacity building and expertise, and in this particular case, in the insolvency and restructuring area. She was formerly with one of the major international English law firms, spent her time in legal practice, not only, of course, in London, but in European countries and in the UAE. She's ideally suited to this topic that is coming up, namely, what is international best practice in insolvency and court systems involving non-financial institutions. Please, Catherine, the floor is yours.
Thank you very much, John. Can everyone hear me? Yes, okay.
Yes.
So in this second half of the program, we'll be looking very much at the effect of the crisis on the corporate sector and what trends we at the EBRD are seeing in terms of insolvency and restructuring, with a focus also on emerging markets. So I think before I outline some of our main observations, I would just like to put these into a context so you have an understanding of how we operate. So we, as an organization, we were in a sense founded at a time of crisis with the fall of the Berlin Wall, and it was really an effort to try and contain this political and economic crisis by setting up an organization to help to countries of the former USSR transition towards open market economies, but at the same time commit to espouse and apply democratic principles. So we have a very much, we are very much a bank that works with the private sector. I think it's quite different from, in that sense, from the World Bank. And we are investors. We invest in loans, equity, but at the same time, we have a legal reform program. So we are present at the moment in 38 countries. We've expanded significantly since our early days, most recently into North Africa after the Arab Spring. And I think we plan to continue our work and in other regions going forward. So as I mentioned, we really were founded to promote transition. And all of the work that we do is driven by 6 transition qualities, which have been recently updated. And these are competitive, well-governed, inclusive, integrated, resilient, and green. And I think insolvency and restructuring falls really between well-governed and resilient. We have an internal debate about which of the transition qualities is the most relevant. But at the moment, we are of course part of something much wider with the UN Sustainable Development Goals, and particularly Goal 8, which is to work towards creating a decent work and economic growth. So we are quite unique, I think, as an MDB, in having a department that's devoted to commercial law reform. We cover 6 main areas. I am part of the financial law unit, and I lead on all of the insolvency and restructuring related projects. I joined the bank in 2012 from private practice, so I have, I think, this dual perspective now of what issues practitioners face, but also what efforts really need to be made to encourage more reform and development of the legal frameworks where we operate. So we have a very, very broad range of activities in the insolvency and restructuring space. We've done a little bit of bank resolution work, but we're primarily focused on corporate insolvency. And I have covered projects that go from corporate insolvency law reform to also non-performing loan strategic plans for central banks. And we also have a very strong research function. So we work on an informed basis through assessments and studies. So here I come to just the general observations of opening remarks I'd like to make, and I think it's clear that we are in an incredibly uncertain time and uncertain period. We don't know how long this crisis will last. It's not dictated by us, it's dictated by a virus. And this is really going to determine how severe the global recession is over the coming years. This is a crisis that has affected both developed and emerging markets alike. And I think while some of the countries in our region have not necessarily been as affected as we have in the UK by the pandemic, everyone is very much affected by the financial crisis that has come out of this. And it's clear that emerging markets, many of our countries of operation, have much more limited fiscal capacity to deal with this crisis and to inject the funds that are necessary to prop up businesses and the wider economy. So many are not in the position like Japan, which has been able to put together a fiscal stimulus program of 40% of its GDP. We recognize that some of our countries are struggling. And I think generally one of the challenges, one of the first challenges of this crisis is which businesses should governments support? So it's clear that all businesses are to a certain extent affected. Some sectors have done well, but some have been incredibly affected. So there are strategic businesses, airlines, just to give an example, which are obvious contenders for government support. But then there is a debate to be had about which businesses should government support, because I think we can't necessarily support all. And as in all of this, from a policy point of view, there has been a particular focus on SMEs, because SMEs have far lower operating reserves, and they really need this financial assistance in some cases to continue operations. So I'd just like to mention a couple of interesting trends that we've seen, and this is in this specific area of insolvency and restructuring. So many countries have introduced emergency standstill, insolvency, in some cases insolvency tax, employment, forbearance measures, and there have been government loans and financing. But generally, it's been the more mature markets that have tried to introduce tailored insolvency amendments. So if I take these four examples here, in Australia, we've seen the government introduce an expansion of safe harbors for trading while insolvent because there are potential liability risks, and the same exists in Germany and the UK. They've limited, they've limited the ability of creditors to rely on statutory demands and acts of hostile filing. Germany, quite similarly, has also tried to minimize any potential liability for directors because they have a very strict 3-week filing requirement on the occurrence of illiquidity or over-indebtedness. And interestingly, in Germany, they've also had to relax some of the lender liability issues because lenders can face liability for lending to a distressed business that would cause, in a way that would cause detriment to creditors. We've seen in the UK, just last week, a new corporate insolvency and governance bill, which has been now made into an act. And that has also a number of temporary insolvency measures that make it actually that prevent creditors from filing a winding up petition if the financial difficulties of the insolvency is related to the crisis. So you have to prove that it's not related to the crisis. And in the US, it's quite interesting. The US introduced last year a Small Business Reorganization Act, which created a leaner, more cost-efficient procedure for smaller businesses, modeled on Chapter 11. I mean, it uses the Chapter 11 and Chapter 11 as a basis. They have raised the threshold for businesses who are able to apply for these measures from $2.7 million US to over $7 million. But what is really interesting is on the emerging market side is really the lack of legislation. So there's really been very little in terms of insolvency law amendments, but we have seen some blanket emergency measures introduced in Turkey and in Hungary. So in Turkey, they simply suspended all insolvency and enforcement procedures. So there were no proceedings could be brought before the court. This is now being lifted. It was lifted on the 15th of June. In Hungary, on the other hand, they adopted a different approach. They simply suspended any loan repayment obligations. Now this is, I think, in effect until the end of the year, but they are now looking at more amendments to their insolvency legislation. And I think there is a concern here, because what we are seeing is the potential now, as a result of this crisis, for some of the countries where we operate to turn inward and become more protectionist. So what Hungary has proposed is a series of amendments which would broaden the definition of strategically important companies to include many corporates, and would grant the state preemption rights in a liquidation sale to be able to buy up those businesses and assets, and in effect nationalize those. So I think there are some real risks that we see coming as a result of the crisis, as countries then try to protect their economies. In terms of insolvency and restructuring, the crisis hasn't really shown us anything new. We have been aware of a number of weaknesses in insolvency regimes, really for a long time. And I think the main point to flag is that in our countries of operation, it's very much a liquidation focused regime. So there is these concepts which are coming out, which have come out from the US for some time and are now coming out of Europe and the European Union with preventive restructuring, encouraging restructuring. This is quite new, I think, still for some of our regions. And we see an urgent need as part of the whole contingency planning that we think really needs to take place to try and support reform, to promote corporate reorganization type procedures, because it's clear that there has to be some safety net in place once all of these government support measures are withdrawn, to prevent unnecessary liquidation of businesses. And particularly because there is a lack of trust among private sector players to do an informal restructuring. And as part of this, I mean, one of the new features, I think, of this crisis has been this emphasis on digitalization. We're seeing it in our work. So we're talking to governments much more about putting in place electronic platform sales, electronic platforms for sale of assets in insolvency. We're looking at electronic court case management systems, and this is all really kicking off. But I think we need in all of this to have a much more holistic view of the legal landscape. And I would argue that we need to look more widely at the credit ecosystem. So not just looking at insolvency and restructuring as a way out, but also, of course, at looking at how can we get liquidity to the businesses that need it? How can we promote lending between international financial institutions like our own and local institutions and local banking institutions? Because we can do a lot more when we go through our financial intermediaries. So as part of all of this, we have launched a series of initiatives, one to support new financing and preventive restructuring, another to look at what SMEs need in terms of particularly information and advisory support. So that's this SME project. And together with Professor Olivares Olivares Kamenal from Queen Mary, we are launching, and indeed John, we are launching an EBRD assessment to look at reorganization within insolvency in the EBRD region. So just some final quick observations. I know where time is up. I think we have to look at this both from the bank perspective and the corporate perspective, and somehow balance or the real perspective and economy perspective and the bank perspective, and somehow strike a balance here. So we know that we know we need reforms to support corporate reorganization and restructuring. At the same time, we need reforms to improve some of these regimes, so enforcement, insolvency regimes, to get a speedier result for banks. And these are typically liquidation procedures. So it's about balancing those two. And at the moment, we talked, I think, about this transition, not knowing if it's yet a banking crisis. And it's just not clear at the moment that we lack the fundamental data. The financial reporting for corporates has in many cases been delayed or postponed because of the crisis, and we don't have the full NPL data for the banking system. So we really just don't have the full picture, and at the same time we don't know where we're going and how long this crisis will last. So it's really very much a balancing perspective here, and I think from our side we're trying to find that right balance between supporting businesses while also supporting banks, because we need banks to support businesses. So that's how I will conclude. And I just for those of you who are interested, I put a slide on this presentation, which just contains some material, some links to a number of initiatives. There are obviously a lot of private advisors who have put together excellent policy trackers, legislative trackers. but IFIs are doing a lot too. And we have now, I think, a general portal for all the work that's being done. And that's the first link that's listed. So without further ado, thank you very much, John.
Well, Catherine, thank you. And the elements that you raised, particularly, I think, how will SMEs fare in the outcome of this crisis? I think that's a very valuable piece of work or pieces of work that you and other IFIs will be undertaking, because of course the value of SMEs and MSMEs to the economies of emerging markets as well as developed economies is incalculable. And if those SMEs just don't get the support in one way or another, if they're just allowed to go under, as you say, to liquidate, it would be a tragedy. So I was very touched by that element of your presentation. And perhaps what we could do is move on to the last of our very good speakers. And thank you very much, Catherine. I'd like to move on to Margarita Meldon, who it's a great pleasure actually for me to introduce Margarita, because she is, of course, the regional program manager for Eastern Europe and Central Asia for IDLO, for the International Development Law Organization, with whom we are partnering on this webinar. And she's had a wealth of experience, as you will see from her CV, that her biodata that has been distributed. She could, like all the other speakers, could speak for probably 45 minutes at least on the topic that she has chosen. But what I was really impressed with this topic is it's a specific example of the sort of the value of the work that is needed to be put in place as we move into the financial impact of the COVID crisis. And that is a culture, as she's put it, of justice to work through insolvency matters, because great justice is needed when you are trying to divide a pool of money that's or assets that is inadequate to satisfy all creditors as well as all investors. Real justice is needed. So without more, please, Margarita, you have the floor.
Thank you, John. Thank you all the previous speakers. It's a little daunting to speak after everyone, because the issues raised were of such macro level and very much policy and legal frameworks oriented. So as Catherine was saying, it's important to take a holistic look. So I was going to present sort of to and the cycle and present more of an institutional perspective and focus on the particular institutional capacity building and the institution building project that we work together on as a concrete example of the role that good, strong, effective institutions should be playing in the current crisis, and how they're absolutely irreplaceable in managing the economic response, in managing the fallout from the COVID pandemic, and in protecting those that need to be protected the most. And I just wanted to say that I think to summarize why this example is important, even though it's tied to a particular country and even though it's tied to one particular institution, it's because in effect, governments can print money and they can draft laws, but they're both worth just paper if they're not implemented correctly, and if who's going to implement it if not in, dedicated institutions. And that's why I hope that there is a clear link between the big picture and the specific legal remedies and the financial remedies that we've discussed, and the small picture here of one particular court in one particular country that actually is entrusted to uphold the best practice. To start, I just wanted to introduce International Development Law Organization for those who haven't encountered us, or just because we're kind of the smaller player among the organizations on this panel. We're also not an IFI, we're an IGO, International Organization, and our mandate is to promote the rule of law. We're also rooted in the Sustainable Development Agenda, Goal 16, which upholds, in fact, institutional strengthening and access to justice. I think it's clear to everybody, whether coming from the financial sector, from the government sector, or from civil society, or from the business side, that without the rule of law, full recovery and fast recovery is not possible. So for us, it's a particular challenge being an institution that is working in the rule of law sector, is to balance all the interests and to make sure that people are protected, that small and medium businesses are protected, because they're effectively the employers who will be letting go of most people if they're made insolvent, and to make sure that there is uniform adherence to best practice and to legal standards. So our guiding principles, I guess I've touched on it, but just to summarize, that we're people-focused, justice-oriented, gender-sensitive, and that insolvency is an issue, even though on the face of it, it's not something that is clearly gender-based, but it is an issue that is in developing country, has a different effect on women and men, and on different genders. We are called local ownership, legal pluralism. Our work is context specific, hence my very specific example. We work for empowerment, and our work is rooted in transparency and accountability and the human rights approach. I wanted to touch on here more specifically on transparency and accountability. Catherine also referred to the trust in the, of the creditors, and I think one of the issues that we need to be very open-eyed about going into this post-crisis recovery, hopefully, is the fact that crisis makes corruption come out even stronger, and that insolvency is an area in particular that is particularly vulnerable to corruption and to corrupt institutions in the time of crisis, and in the region that we're discussing in Eastern Europe and Central Asia. And that corruption vulnerabilities range from the way that aid is distributed to the way that insolvency cases are adjudicated and processed, and due process is administered. So just to summarize where we work, as you can see, we have quite an extended global reach, but in our region we work all the way from Montenegro to Mongolia, and very much of this work is done together with the European Bank for Reconstruction and Development. So I wanted to quickly highlight our important partnership. We started working with the BRD back in the early 90s when Eastern Europe was going through the post-socialist transition, and a lot of important commercial law reforms were done at the time together by our institutions. I can't speak much for that because I wasn't there, but I can definitely talk about the framework agreement, which was signed in 2017, and which now encompasses 11 countries and 17 programs, and which is hopefully going forward to be expanded in the coming year. we work together on dispute resolution, on gender, technical assistance, and legal awareness. And this partnership is particularly important because we bring together expertise in subject matter, in implementation, local focus, and international best practice. And the project in Armenia is an excellent example of complementary functions and how the design and the conceptualization, design, technical assistance, and implementation were triangulated, and the important role that EBRD had in addressing holistically the insolvency reform process in Armenia was translated into bringing IDLO on board to give institutional capacity building assistance to the insolvency court. Just going back to say that our work is very much rooted in justice sector institutional capacity building, and we work on offering support to justice sector institutions in areas which enable and empower better functionality, transparency, accountability, and effectiveness. In particular, for example, we work on better financing for judiciaries, and we've worked across the region on bringing up the financing of the judiciary to 2%, which is considered a best practice for developing countries. We also work on anti-corruption reform and on specific issues in the justice sector with regards to selection of, for example, judges or prosecutors. Here, it's also an important element of the transparency, accountability, and effectiveness of the insolvency court, seeing that it's consisted of specialized judges. And we also work on specific legal reform, and in particular in commercial law across the region, on introducing new legislation, or amended legislation, and on providing digitalization solutions for justice systems, something that I think was touched on in the previous presentations, and something that is escalating or becoming much more rapid in the aftermath of the COVID crisis. So with that, let me go straight into the example. So the case study concerns the Special Insolvency Court in Armenia, and this is an example of how it's important to build up resilience of justice sector institutions, as they're the ones who will be driving the cleanup, let's say, of the economic fallout from the COVID-19 crisis. And just to say that the resilience of justice sector institutions is based, of course, in their role in the justice chain. In particular, this is important in the former Soviet Union and to a lesser degree maybe in Eastern Europe, where the judiciary has struggled to establish its independence and struggled to be viewed as anything but an auxiliary or even a stepsister to other branches of the government. And for that, it's particularly important to view the economic potential and investment attractiveness of countries through the prism of how good the judiciary is. In Armenia, in particular, the creation of the court, it was based, let me just start with the legal basis, was based in bankruptcy law and the judicial code. And the key stakeholders, which Catherine specifically convened in order to make the, to sort of start the assistance to the court and the action operationalizing of the court on the right foot, were from different key areas, including the justice system, Supreme Judicial Council, the Judicial Department, even Judicial Academy, from the private sector. And here I want to mention KPMG, who was one of the key advisors on this project, and who, of course, being a insolvency practitioner, offered very important and well received advice, and insolvency administrators, and finally, of course, the customers of justice, the creditors, debtors, and their representatives. supported by international partners who, in addition to VRD and the IDLO, also include other important IFIs on the ground and international technical assistance partners. So the action plan for operationalizing the insolvency court, it was based in an analysis of risks and the recommendations that we derived from those risks. And the ultimate goal, as visualized and conceptualized by VRD, was that transparent, unbiased judgments in insolvency cases are given, and the analysis and the recommendations were structured around the structure and operations of the court, took into account statistics and the data that the court generates or doesn't. An important part of the analysis was the ICT function, including integration with other actors, such as the insolvency administrators or the general customers of justice, but also including the security and professionalism of ICT solutions, also as a way of ensuring transparency of the process. And this ranges from everything from antivirus to making sure that there are adequate domains for insolvency judges and that they don't use gmail.com, you know, for official communications, which could be the case. And moving on, an important aspect which was taken into consideration from the beginning, from the establishment of the court, is the quality of the judges and specialization of the judges. So they were selected from across the country, underwent selection process, but there are also specific recommendations given to the performance management and training necessities of the judges to make sure that they stay current and that they have technical capacities to consider cases quickly, efficiently, and accountably. In effect, this is something that our institutions are also addressing as the COVID crisis has put a very urgent need for the judiciary to be trained up and for justice sector personnel in general to be trained up on insolvency. An issue that has been blatantly obvious from the beginning is the lack of standardized procedures and guidelines, especially for interpreting complex financial information, but also for case management. And in that regard, I will also come back to that, but that is something that starting from opening of filing of the insolvency case was in need of standard procedures and in need of clarification, and in order to ensure predictability of outcome practically.
I apologize to interrupt, but I just wanted to announce to everyone that because we started just a few minutes after the hour, almost 2 hours ago now, we will go on for another few minutes. But please, Margarita, maybe if you could keep to 2 or 3 minutes, and then it'll give us time to wrap up. Thank you very much.
Absolutely. So all the recommendations that were provided were based on international best practice, and the practice from it was benchmarked against Slovenia, Estonia, Germany, UK, United States, and Russia. And the recommendations were also grouped around the following indicators: transparent and unbiased and predictable, prompt, efficient, professional, and trusted. And the recommendations to facilitate implementation were also clearly assigned to specific personnel or responsible parties within the justice system, which in effect made it easier to monitor the implementation of the action plan. And some of the mechanisms that were put in place in order to make the implementation more effective and effectively monitored were the results indicators and KPIs, assisting, as I said, responsible persons, but also strict timelines for adoption of new procedures and for operationalizing, and the monitoring and adjustments provided by the technical assistance providers. And the first monitoring presentation took place right before COVID in February. And if you're interested in further details, they're also available here. We put a link where you can find the more technical discussion in case this is something that can inform further thought or policy dialogue. Thank you.
Margarita, thank you very much. And as I was predicting, this shows a very specific set of projects and a particular project that I think could be a useful template for other countries throughout the emerging world. I was really struck by one thing that you said, Margarita, among many, but one thing, the need for transparent, unbiased judgments in insolvency cases that then generate trust. So many presentations I've been involved in or listened to have stressed the absolute need to build trust. And the fact that insolvency presents special risks, particularly corruption risks, I think just shows that the work that you're doing, not only in Armenia but elsewhere, is so important. Now, we still have not had questions, but there are two elements that I'd like to mention on the question front. The first is, please, to all of you who have been with us through these past 2 hours, if you have particular questions, please present them, not necessarily on the chat, the chat field in your screen, but email them to any one of our presenters, because we'd very much welcome your feedback, your commentary, and in particular, whether you would identify that there might be issues that we should be addressing in possible future webinars. I do have then one question of my own to put to each of you. There's great importance in establishing, as we said, proper insolvency courts. How important are non-judicial procedures in this area? Mm-hmm. And in particular, how can we, if they're important, how do we ensure that the non-judicial procedures are corruption-free?
Okay.
I guess, Catherine, would you like to have
yes. I will try and cover those 3 points, John. So I'm conscious in my presentation I didn't say much about the role of courts, because I knew that Margarita would be presenting the project that we did in Armenia. And I think just to finish off on that observation you made about relevance for other countries of operation and other emerging markets, I think absolutely this is the first project of its kind, really. We did it in a very small country, which in fact set up an insolvency court because they'd had a commercial law court before, but there'd been a lot of corruption, and they closed it. They went back to a general court system, but then recognized the need to really consolidate specialization and expertise in the area of insolvency. So it's a bit of an experiment in Armenia, and I think that it's tremendously important for there to be specialized judges managing insolvency cases, for 2 reasons. One, because specialized judges are the ones who then receive the most insolvency cases and have that practical hands-on experience, and also because it's much easier for the competent judicial training academy and others to offer training to a smaller pool of professionals. I had this issue in Cyprus where it would have been a question of training the whole of the country's judges on insolvency, and that's quite hard to do. So I think insolvency courts are very, very important. There is now this tension between how much do you require to go through an insolvency court and how much can be done out of court. So as many of you I think will be aware, there's international organizations like the World Bank and the IMF have been pushing for so-called hybrid procedures. And in some cases where it's a restructuring that's happening in the earlier phase of financial difficulty, perhaps the use of a different forum. So I've been involved in Serbia in a project which was set up through the IMF. It was a law that the IMF had promoted, which was for out-of-court consensual restructuring under the auspices of the Serbian Chamber of Commerce. But going back to this issue about trust, we still find that these experiments, these initiatives to try and create something out of the court system that can look a little bit like the court, they're not necessarily that successful. And the reason is, apart from lack of trust, it's also risks. So if you are a bank creditor doing a deal with your debtor out of court, you often want to have court approval or court recognition of that agreement because you want to protect it from challenge by third parties. So in places like in countries like Ukraine, there were at the time of the Ukraine crisis a lot of efforts to do restructuring out of court, but you would always go to the court to get that court approval. And in terms of corruption, I'm putting my hopes in technology because we are, as I said, we are becoming more digital. That's the one, I think that's the one consistent trend of this crisis. We are seeing it in this area of insolvency. Unfortunately, the insolvency court in Armenia is not at all digital, and Margarita will remember that when we visited it together, we were shown the court office with all the court papers and documents which were piled up to the ceiling in various directions. And it's still, even now, there's a certain resistance, I think, towards, in some courts, digitalization. Even actually in the Law Society in England and Wales was concerned about the fact that digitalization can leave certain stakeholders behind. So there's a balancing act there, but generally digital systems, electronic case management, sharing of information, because often information is not shared with creditors, that helps fight corruption. It must do. It certainly makes things more open. It's much more difficult to hide, and particularly in the area of electronic platforms and auction sales, where putting them on an electronic platform for everyone to access stops the deal in the back room. So, and it's also about insolvency practitioners as well as judges, I have to say, in all of this.
Well, thank you very much. No, that's really helpful. And Margarita, I was going to ask for your views, but I'm pleased to say that there's, in addition to some very nice compliments from some of the colleagues who've joined us on this webinar, there is one question. So please, I will, if I may read that one, because it's really important that we address. It says, from Julio Ronzino, in Europe, we are experiencing an extension of resolution regime, not only for banks, but also for CCPs. For instance, recent EU Council Parliament agreement on legislative proposal. Taking into account the increasing importance of fintech in the payment service providers, do you see the need to introduce a common resolution regime also for payment providers? The ongoing Wirecard case might point to such a need. Indeed. That's the question. So is there something that needs to be, that you feel needs to be introduced, a common resolution regime also for payment providers, not simply for banking institutions? Would either of you like to address that? Or it could be addressed separately, with you, either you or our speakers, of course, on the first panel. Any one of you on the panels, whether there's something special that could be addressed in the context of payment service providers who aren't, as it were, they're providing a service to the banks, but they're not actually banks, although they might have a bank within their organization, just like Wirecard has had.
John, maybe if I just
please, Marco,
say a few words, remarking that this is probably a topic for a webinar in its own. As you were actually, as we were actually recalling just before. I mean, I think that the whole point of having a resolution regime in place is to allow the authorities to avoid the creation of, let's say, systemic risk and to produce financial instability. So in every case in which the failure, the insolvency, or let's say the non-viability of a financial operator as such is potentially able to endanger the financial stability, then probably we need to have in place a regime providing the authorities with special tools. At the end of the day, the resolution regime is not just for banks, but also for investment firms, provided that their crisis or their insolvency, their condition of being failing or likely to fail, can destabilize, if you want, the financial system. So just to give a very short answer, it might be the case that some sort of reflections on these need to be developed.
Thank you very much, Marco. That's indeed, and I think it could be an interesting topic for us to address. And one last, if we have time, but please, I'm speaking very much under the direction of our IDLO colleagues, who I want to introduce in a moment. What I'd like to say is I've had one additional comment, and it's to everyone, a question to everyone. Appreciate if you may provide us with your recommendations to mitigate the effects of the current crisis. Anyone like to have a shot at that? Of course, it does go into huge areas of policy rather than law, and I know that each of you have been addressing legal issues and the way in which the law could contribute to a proper development of the way out of this crisis. But if any of you would like to speak up on that.
Perhaps I could just start with a general observation, John. I think I see insolvency, restructuring, and enforcement laws and regimes as absolutely critical. And again, I'd like to make the point both for banks and for businesses, because and the wider economy, because you need a robust secured transactions regime to encourage secured lending and liquidity to businesses. You need this because banks, in many cases, we know, are coming under immense pressure to lend to businesses by their regulators, whether it's formal or informal. And we're seeing that already in our region. So you need to at least address this issue of risk and ensure that they can do this in the most protected way possible. And if you're looking at the issue of non-performing loans, of course you have all of the tax and the regulatory aspects and what banks are permitted to do in terms of transferring non-performing loans, who is able to purchase them, who is able to service them. But at the end of the day, you have to work through these loans, and you need the tools to work through them, and therefore you need robust restructuring regimes, insolvency regimes, and of course enforcement regimes, depending on the situation. So I think that for me is really at the heart of it. And then of course bank resolution regimes recovery and resolution regimes are incredibly important for the financial system, for protecting those systemically important banks, and not only, I think as Pamela mentioned, maybe also other banks. So that is, it's all interconnected.
Indeed. Thank you very much, Catherine. Would anybody else like to comment? Well, look, if not, I realize that last question was, of course, extremely broad. And there is one further comment which has just come in. Could you introduce the purpose? Yeah, to minimize the risk of turning world economy into a deeper crisis, could you introduce the purpose of the action and the practice of short-term liquidity lines? Do you think short-term liquidity lines could alleviate the lack of liquidity in particular countries and prevent its spillover effects on other countries? Any views on short-term liquidity lines? Of course, you know, I think a lot of what has been pumped into at least into the world economy generally, but particularly in the developed economies, it have been huge amounts of liquidity just pumped into the system from the central banks. Some of them are short-term and others will be longer-term liquidity lines, I believe. But please, any comment? Well, if not, I would now like to, I think we could say that we've come to the end of an extremely fruitful discussion among you, and I'd like to thank each of you personally, each of the speakers today for excellent presentations, on point and keeping as much to time. What I would like to do now is to give the floor as the final word to Lorenzo, who is going to say a few concluding remarks on behalf of the International Development Law Organization. Lorenzo.
Thank you very much, John, and thanks everybody for being here present today. I want to say just on behalf of the IDLO that we are extremely happy about this webinar, which focused on a topic that is not just interesting, but is very much central in current affairs. So I think it was a very, very productive and important discussion. I would like to thank, of course, first of all, my colleagues from IDLO that helped organizing this webinar, Ljubomir Petruljesko, of course, Margarita Meldo for presenting and assisting in organizing, and also our intern, Eric Elter. And also, first of all, Queen Mary University, who helped us very much in the organization of this webinar, from Mary Mitzi, who is here present and helped us and assisted us all the time, and John for being moderator and for helping us, Marco as well for not just being a presenter, but also for helping us in the organization of this webinar. And most of all, I would like to thank the speakers from very, very important and crucial international financial institutions, from Mr. Emre from the IMF, Ms. Lintner from the World Bank, Marco Bodellini from Queen Mary, Ms. Catherine Bridge from the EBRD, with which we cooperate as IDLO since long time ago, as Margarita reminded, and Margarita Meldon as well from our side. I would like to thank also, last but not least, all the participants. And I would like to encourage once again, as John already did, everybody to send us feedback and questions so we can not just reply, but also take them into account for future events similar to this one as future possible topics for discussion and to keep the discussion going on. So once again, thank to everybody for the organization, and I wish everybody a lovely rest of the day.
Wonderful. Thank you.